Fidelity just dropped a bomb of a report, and for once, it's not all doom and gloom. No recession drama, no market crash headlines, and this time we actually broke a record. And I'm not hyping it up, that's straight from the source, considering the kind of economic whiplash we've all been dealing with lately, and that's something to take very seriously. So here's what caught my eye. According to Fidelity, the 401k savings rate just hit 14.3%, and that's not just good, that's phenomenal. To put this in different perspective, just a few years ago, we were celebrating when people hit 10%. Now we're cruising past 14%. And honestly, it gives me hope for everyone's retirement future. But you want to hear the interesting part. Even though we're saving more than ever, the actual account balances took a little hit from Q4 2024 to Q1 2025. Your 401k, 403b, and IRA balances all ended up slightly lower than they were at the end of last year. Now, before you start panicking and thinking the sky is falling, let me remind you that this is classic market behavior. The markets went through some turbulence in the first quarter, which is about as surprising as finding out that politicians make promises they can't keep. But here's the beautiful part, and this is what separates the smart investors from the panic sellers. People don't just weather the storm, they actually increase their contributions during the downtrend. Sharon Brovelli, who heads up Fidelity's workplace investing division, put it perfectly when she said, despite market volatility in the first quarter, people stayed the course and continue to prioritize their long term financial security. And I agree with her. It shows that people are learning from past mistakes and they're playing the long game. That's the kind of attitude we need to see, no matter where you are on your financial independence journey. So I was looking through the full Fidelity report, which by the way, you can find the full analysis on their website. Just search for Fidelity Q1 2025 retirement analysis. They lay out a lot of data there, which is pretty eye opening. And there were a few things that really stood out to me. Now, let me touch on something that doesn't get nearly enough attention, and that's the 403b savings. And the rate came in at 11.8%, which is solid, but not quite as impressive as the 401k numbers, but still impressive. If you're wondering what a 403b is, it's basically the retirement plan for people who work at nonprofit organizations like teachers, hospital employees, or people at religious institutions. It's very similar to a 401k in how it works, but the rules are just slightly different, mostly in how it's set up by the employer. But the important thing is, people in those plans are also saving at a pretty good rate, not as high as the 401k, because many large nonprofit organizations come with a pension plan. Looking at the average retirement balances, specifically from Q4 2024 to Q1 2025, we do see those slight decreases I mentioned, largely due to market volatility in the first quarter. For instance, the average 401k balance was about $127,000 and it's down about 3% from the previous quarter. But does that really matter? Honestly, I don't think 3% is a big deal. And for IRAs, the average balance in Q1 2025 was $121,983, showing a 4% decline from the previous quarter. And for 403Bs, the average balance stood at $115,424 in Q1 2025, which was down about 2% from Q4 2024. Again, this is not a sign of trouble. This is just market volatility doing what it does. When the stock market goes on a little roller coaster ride with tariffs, your account balances will reflect that. It's normal. What's not normal, historically speaking, is that people largely did not panic and pull their money out. They stayed a course. And if you're one of those people who held steady, good for you. That's exactly what I did in the first quarter during the volatile market. I just stayed a course and increased my contributions. Now, let's talk about the total 401k savings rate of 14.3% because it deserves some serious attention. And this isn't just employees throwing their own money, this includes employer matches, which means the total package going into retirement accounts is hitting levels we've never seen before. But here's where the story gets really interesting. When you zoom out and look at the bigger picture, long-term average balances are up 19.7% over the past year, despite these quarterly dips. That's the power of consistent investing. The truth is, short-term market hiccups won't matter in the long run. This is why I always tell people, do not get caught up in the day-to-day noise. Now, Fidelity also looked at how employees are actually behaving with their money, and these insights are pretty cool. And we saw an increase in Roth 401k contributions going from 15.2% of contributions to 16.8% in just a year. This tells me people are getting smarter about taxes in retirement, and they're thinking, you know what? I'll pay the taxes now and let that money grow tax-free later. It's a good move for a lot of people, especially if you think tax rates are going to be higher in the future. And I have been putting the employee contributions into my Roth 401k and the employer contributions into my traditional 401k for my financial independence because my tax rates are lower now at 24%, but I believe the tax rates will be higher in my retirement. And I'd rather have more tax-free retirement than tax-deferred retirement. And here's something that makes me smile. 401k loans dropped from 2.4% to 2.3%. Now, I've got to be honest with you here, and I'm completely anti 401k loans. And I know life happens, emergencies come up, and sometimes you feel like you've got no choice but to raise your retirement account. But borrowing from your future self is like taking money out of one pocket to put it in another, except the first pocket has a hole in it. So seeing this number go down even slightly is a good sign in my book. It means fewer people are digging into their retirement savings for short-term needs, which is exactly what we want to see. And if you're one of those people who love 401k loans, sorry, buddy, I'm never going to agree with you that a 401k loan is ever a good idea because it's not. This is from someone who once took out a $10,000 TSP loan when I was on active duty in the military. I missed out on compound interest way too much. It is not worth it. Moving on to IRA contributions, and this is where it gets really interesting for you guys. And the IRA contribution story is equally compelling. And the contributions are up 4.5% from a year ago, which tells me people are taking their retirement planning seriously beyond just their workplace accounts. Now, if you're a baby boomer, your average IRA contributions went by a massive 21% from a year ago. And that's fantastic. And it shows that even later in your working careers, you're still pushing hard to save, which is exactly what you should be doing. You're setting yourselves up for a strong retirement. And I respect that hustle. And if you want to schedule a 60-minute consultation with me to talk about your financial independence strategy, you can visit firesightchat.com/consultation. So the big question is, why are we seeing this impressive increase in the contribution rate? What's driving this record high savings behavior? Well, it's not just one thing, but a combination of factors, and some of them are quite clever. First off, a significant chunk of 401k investors actually increased their savings rate. We're talking 17.4% of them. And get this, only 5% decreased their savings rate. And that's a huge imbalance in the positive direction. And it means people are actively choosing to save more. Even when the market is a bit choppy, they're not getting scared and pulling back. They're pushing forward. That's the kind of resilience we need to see. And if you're doing this, you're doing it right. Now, a major driver behind this trend is the automatic enrollment for new employees and automatic annual increases. And it's a powerful tool that employers are using more and more. In fact, more than a quarter of 401k plans now offer an automatic annual increase feature. What this means is that every year, your contribution rate goes up by a small percentage, or typically 1%, unless you actively tell your employer to stop it or increase it more than 1%. It's like a silent raise for your retirement, right? You barely notice the extra deduction, but over time, it adds up to a substantial difference. So here's how it works. 35% of 401k plans now default to automatically enrolling employees at a 5% contribution rate or higher with a 1% annual increase until they reach 10%. The best part, employees rarely opt out. When you make savings the default choice instead of the active choice, people tend to go with the flow, right? And it's like putting your retirement savings on autopilot. Another huge factor in people staying the course and increasing their contributions is the popularity of target date funds. And more than 60% of 401k investors put their money into these funds. And if you're not familiar with them, a target date fund is a type of mutual fund that automatically adjusts its investment mix over time. And it starts with more aggressive investments when you're younger, then slowly shifts to more conservative investments as you get closer to your target retirement date. So if you're planning to retire around 2040, you would pick a 2040 target date fund. This strategy really works, and especially during market ups and downs. For example, 81% of Gen Z, the younger generation just starting out, are putting their money into target date funds. They're learning from history and letting the pros manage the asset allocation on their behalf. And since most target date funds are index funds, they don't cost as much as the actively managed mutual funds, but some can be actively managed. So just be careful with the fees when you do the research. So how do you pick the right one? Let's say you're 55 years old today and planning to retire at 65. you will want a 2035 target date fund. And if you're feeling aggressive and want to work until 67, maybe you can go with a 2040 fund. The key is being realistic about when you actually want to stop working, not when you hope to win the lottery. And this brings me to my final point on why the contribution rate increased. People are not panicking. And despite the market volatility in Q1 2025, only 6% of investors actually changed their asset allocation. That means a massive 94% of people just stayed the course. They didn't sell low, they didn't get scared and pull their money out. They trusted the process, or perhaps they just let their target date funds do the work. This patience, this discipline is absolutely crucial for long-term investing success. You can't time the market. You just can't. So staying invested throughout the dip is how you capture the gains when the market recovers. And if you're one of those 94%, you should feel very proud of yourselves. Now, let's talk about the ultimate goal for many of you in becoming a 401k millionaire. And with these kinds of savings rate and behaviors, I'm telling you the number of 401k millionaire is only going to continue to increase. And if you look at Fidelity's data, it shows us that those who have hit the 7-figure mark in their 401ks actually save an average of 26.2% of their income. So let that sink in for a moment. That's a pretty aggressive savings rate, but it shows you that's possible when you prioritize your retirement. So the people who hit that 7-figure mark, it took them an average of 26 to 27 years. Can you believe that? They just stayed consistent through everything. And when I say everything, I mean everything. The dot-com bubble burst, the 9/11 attacks, the Great Recession, COVID, and the high interest rate environment we've been dealing with for the past 4 years. Through all of that chaos, they just kept putting money away consistently through thick and thin. Now, I'll be honest with you. I've been maxing out my own 401k since 2017, and I'm not going to pretend it was always easy. There were definitely months where I looked at my budget and thought, well, am I crazy for putting this much away? But then I see a report like this, and it's like a shot of adrenaline, right? And it reminds me why we're doing this in the first place. It proves that this strategy, our strategy, actually works. So what's the takeaway from all this? The market's going to do what it does. Sometimes it goes up, sometimes it takes a hit. But if you're steadily saving, taking advantage of your employer match, using tools like Roth contributions and target date funds, and avoiding early withdrawals and loans, you're doing better than you think. The numbers back it up. More people are saving, more people are staying consistent, and more people are refusing to let short-term noise affect their long-term goals. That's how 401k millionaires are made. Not in 1 year, not in 5, but over time. With smart moves, steady contributions, and yes, a little bit of grit. And if you've been doing that, then I salute you. And this has been another beast of a video, and I hope you got a lot out of it.